Agenda for today's meeting. I'll call for a motion to that effect, please.
So moved.
May I have a second?
Second.
Motion and a second. Is there any discussion? All in favor of adopting the agenda that's been put forth, please say aye.
Aye.
All opposed likewise? The ayes have it. All right, folks, next up, I hope you all have had a chance to review the minutes from the June 13th, 2024 meeting. Any comments on that before I make a motion to approve it?
So moved.
I have a motion to approve it. Do I have a second?
Second.
All right, any discussion on the minutes from the June 13th, 2024 meeting? There's no need for discussion. All in favor of accepting these minutes, say aye.
Aye.
Likewise, for no? The ayes have it. The minutes are approved. All right, next up is your chairman's report. We have some elections to make, and I'm going to turn it over to the CEO to kind of referee us through this.
Thank you. Mr. Chairman, it is every 2 years pursuant to our governance policies, we do elect a chair and vice chair, and we also the commission picks committee assignments. I believe that, in kind of conversations, there's, given that, we're kind of on the precipice of a period of transition with the commission, given that we're going to see the impact of term limits that were put in place by the 2017 legislation, that there was a kind of, from what I understand, consensus to maintain the status quo regarding the chair and the vice chair, and just to give us an opportunity to see how things, to a certain extent, shake out over the for a change after that, then we can address that at that point. But it's my understanding that the consensus of the commission would just be to keep the chair and the vice chair in place for this term.
Well, being as that I've been nominated to serve as chair, would it be proper for me to abstain from commenting or voting at this point? And same thing with Missy for vice chair.
I mean, my suggestion would just be for if someone would make a motion to maintain the chair and the vice chair, and you can just do it by acclamation, and then.
I can continue to serve.
Second on that.
Second. I'm sorry.
We need a second.
We have a second.
All right, second.
So all in favor? Aye.
Aye.
Aye. Any opposed? The ayes have it. The chair and the vice chair stay the same. All right, next up is the commissioner committee selection. As you know, we've got the Human Resources and Compensation Committee, as well as the Audit and Enterprise Risk Committee. Again, I'm going to turn it over to Mike here and let him kind of guide us through this.
Thank you, Mr. Chairman. And, this is, as I mentioned before, this is the period where at the end of the 2-year period where commissioners would pick committees. And pursuant to the policy, I solicit interest from the commissioners, and then you propose a slate of committee members to the commission for its approval. I polled the commissioners prior to the meeting. There was a basically unanimous agreement for commissioners to desire to remain on the committees that they're on. So my suggestion would just be for there to be a motion just to reaffirm the committee assignments as they are presently for the next 2-year cycle.
So moved.
So we have a motion to that effect. May I have a second? I have a motion and a second. Any discussion? All in favor of seating the committees as illustrated today, please say aye.
Aye.
Any opposed? Ayes have it. The committee assignments have been made.
And just for purposes of the meeting, the committee members for audit enterprise for risk management, are Ms. Peggy Boykin, who is a designated member given her role as the executive director of PIBA, Ken Dion, Mr. Bill Condon are the three members of the Audit and Enterprise Risk Management, and then Human Resources and Compensation Committee are Ms. Missy Schumpert, Mr. Bill Hancock, and Dr. Holly Olber.
Okay. All right, next up is committee reports. I'll let the committee chairs report to that. I know that the Human Resources and Compensation Committee met. Missy, any comments to that since you're chair?
Well, yes, we met on Wednesday, August 28th. And I'm not sure if now or when we go into executive session, we want to, executive session. There's really nothing to report from that meeting other than our normal review. There will be one matter that we will take up in executive session. We'll discuss then.
All right. Is the chair of the Audit and Enterprise Risk Committee here?
I'm here. Can you hear me?
I can hear you, Ken.
Good. I don't have anything to report unless Mitchell does.
They didn't meet.
They didn't meet? Okay, they did not meet. All right, so that's those are the reports from our committees. Now, next item up is the Chief Executive Officer's report, and I'm going to turn that over to Mr. Hitchcock.
Thank you, Mr. Chairman. Two items in my report. One, you will see in your packet a list of proposed meeting dates for next year. We try to, those meeting dates generally track the our strategic calendar that the commission adopted several years ago. We have a couple of kind of suggested deviations from that in both, I believe, in the April meeting, just because there's a conflict with spring break, like for us for those of us who have children still in school. So we just asked to move. We're looking to move that up. I think everything else is pretty much according to the strategic calendar, but these are just for you guys to take a look at. We'll come back in December and actually approve the dates for next year. So,
Do you know? Can you tell me when the April one is? Because I do some travel planning.
yeah, it's April.
April 10th.
10th. It's April 10th.
April 10th.
It's just the date.
Okay.
Also, the second item for my report, Mr. Chairman, it is time for us to make our recommendation for our budget proposal, our budget request for the fiscal year 2025-26. Basically, bottom line up front, I'm not requesting that we ask for any additional authorization in total. I am looking for us to move some money from other operating expenses into our personal services and benefits line. So moving $600,000, basically in the way that we would describe it in the budget, move it up from other operating expenses into $400,000 into personal services, and then $200,000 into the line where we pay for the benefits that are related to compensation. But just to start out, this is our organizational chart. Certainly happy to answer any questions about this. One of the kind of notable changes, as you see, we promoted Sally Fulkert to Chief Human Resources Officer. She does have now 3 direct reports under her, and that's probably one of the most significant changes that we've made since the last time that you've seen this.
Mike, it looks like there's no unfilled positions at the moment.
There's nothing that we're looking for. Ed, there's always an opportunity. We carry vacancies when you look way down at the bottom for the associate program. So, we do have some positions there, but there's a churn in that program. So
what strength are we at?
We have 39 FTEs right now. We're authorized up to 51. But we feel like we're a good, solid complement.
Did I understand we're actually at 39?
Yeah, that's correct. Yeah,
Is that less than it's been over the last few years?
That number's been pretty stable, like 40, like 39, 40, it's been pretty stable over the past several years. As we talked about previously, especially when it comes to the investment team, we've decided to approach this from a smaller team model, where we like to feel like we can stretch people, give them challenging work to do, but also be able to provide a level of compensation that makes it attractive for them to stay here. So,
Mike, I have a question. I'm sure you've already baked it in, but assuming that the variable compensation program gets maxed out, in other words, we're as successful as we hope to be, your changes have compensated for what those numbers might be.
That's right.
If we're hitting it out of the park.
That's right. And that's a great segue, because part of what we're asking for right now is an incremental change to Barbara Cresswell and Brian Wheeler on our staff have done a fantastic job with 5-year budget projections. So, and taking into consideration the full impacts of things like DCP, which is, as you noted, I think it's very much a success problem. So, we'll probably in the coming years, we will need to ask for additional authorization. But there is we have a kind of a stepped up approach to that over the next couple of years. But there's not a need for us to ask for additional authorization this year. But I would assume if we continue on a path where, our folks continue to outperform, then, probably for FY27, we would need additional authorization. But the other thing is, and let me back up one, this chart, as you can see, goes back to FY18, where our budget request was static for a long period of time, and it was static even farther back than this. If you go back to, I believe it's FY16, we asked for over $17 million in authorization and received it, but we gave it back over the course of a couple of ensuing fiscal years. So even if right now we're not even close to the high water mark, which was 10 years ago, basically.
Okay.
And this is just a breakdown. So our budget kind of breaks down into 3 big chunks: personal services, other operating expenses, and employer contributions, for a total of $16,503,000. And this gives some detail on, as I indicated, we're asking for a $600,000 reduction to the other operating expenses. We've been able to continue to implement some cost-saving measures by consolidating services, especially with the Bank of New York Mellon, through our custody contract that have allowed us to reduce overall operating expenses. And we're distributing that into $400,000 to increase personal services, and then the corresponding $200,000 for the necessary employer contributions to compensate for that increase.
Like how much of their funding, our funding is self-funded?
It's all self-funded.
So that's what I thought. So,
Yes, sir. Yeah, and
so that budget request that you submit has to be approved, but essentially we fund it.
that's right. And so the best way to think of it is there's an appropriation, which is the state is providing an agency with state funds. Ours is an authorization where the General Assembly is authorizing us to spend up to a certain amount of trust funds in order to operate. So we take no money from the general fund from the state. It's all.
But it must be approved by them.
That's correct. Yes, sir. This just gives a breakdown on our FTEs. We're always in the market for, we have kind of allocated for growth if we feel like we need it to 3 investment officers. We're 4 investment associates, and then we like to keep a ready reserve of additional vacancies just in case the commission were to take a different approach to the portfolio.
Mike, in that authorization process, once it to be approved, does that include, or is there any part of it where the organizational structure is implemented or questioned? Or that's entirely up to us?
We have a significant amount of latitude to determine how we operate. So, we statutorily, the commission hires me, and then the staff, ultimately the staff is, all of our staff are at will, including myself. Eventually, everybody reports up through to me, and I structure the organization based on the plan, kind of the broader plan that we approve as part of the budget recommendation.
So the legislature, as part of that budget process, does not instruct you in any way as to how the organization needs to be.
No, not with any level of detail.
When you say at will, you mean at the will of the commission? Is that?
Yes, ma'am. I serve at your pleasure. I serve at your pleasure, and then theoretically everybody else serves at mine. But we don't.
Okay.
We don't exercise that. We don't exercise that authority very often. So, we have two provisos that we have requested for the budget. One is, and these are both currently in the budget. We're just asking that they be continued. One is suspends the requirement for us to have a fiduciary audit. I believe it would be this ensuing fiscal year, or the 26 fiscal year, where this would have an impact. So we're just requesting that stay in. And then the exemption that we have from procurement for the custodial banking relationship. We've been able to maximize this exemption to consolidate a lot of services, which has resulted in a lot of savings for the organization. And that is it. So certainly happy to answer any more questions. Anyone has
Questions for the Chief Executive Officer? As I see the baton being passed, I think it's now time for the Chief.
I'm sorry. We just need a motion to approve the request as presented.
All right. I'll call for a motion to authorize the CEO to submit a proposed fiscal year 2026 detailed budget substantially similar to the draft budget presented for inclusion in the governor's annual budget. I have a motion and a second. You want to discuss it anymore? Hearing no discussion, all in favor, aye?
Aye.
Any opposed? The motion carries. Now to the Chief Investment Officer's report. Yeah.
All right. Thank you, Mr. Chairman. Morning, everyone. I am going to, as a gift, be extraordinarily brief because this is the time of year where we actually ask our consultant to give us their thoughts on perspective, but I do have a few highlights I'd just like to point out here. So,
yes, you do.
First of all, we did earn roughly 10.5%, outperformed our benchmark pretty nicely for the year. I'm very pleased with that outcome, as well as the continued professionalism and high standards our staff holds itself up to. One thing I want to point out on this page, and I'm not going to hit the focus button because I'll accidentally leave the presentation, is if you look at the bottom of the page, the net benefit payments, net benefits is benefit. This is the amount of money that we take out of the portfolio on a periodic basis to add to the contributions into the system in order to make the benefit payments for the retirees. And this number has, on a one-year basis, gone positive, meaning over the fiscal year last year, we brought in more money through contributions than were distributed, meaning there was a net inflow over the course of the year into the plan. 5 years ago, if we were looking at this, that would be negative, and it would be negative to the tune of almost, I think it's 1.08 billion, or 3.5% of the plan's assets at the time. So this is a tremendous development as far as the liquidity risk, not only of our portfolio, but of the broader pension system is concerned. And that's something that I don't want to get lost and buried underneath the returns, because that is a really important development.
Do you know what is behind it? What caused it to happen? That's not something we have any control over, right?
That guy right there had a lot of influence in this.
That was not the answer that was going. One of, we've seen I think payroll growth is ahead of where we would have expected it to be. The General Assembly has, I think the COLA, I believe it was 2 years ago, was the cost of living adjustment was 5%. And so, we've kind of seen a lift the payroll that we hadn't seen in a significant amount of time. And so we're bringing in more in contributions than we necessarily had thought that we would be at this point. I think so. The mechanics of that is is payroll growth.
Mike, the adjustment for inflation and Social Security payments is estimated in 2025 to go up 2.5%. Are our pensions in any way related to that CPI?
The actuaries have a payroll growth number that it underpins. It's one of the key actuarial assumptions. They revisit that number, I believe, once every 5 years and once every 4 years when they review the actuarial assumptions. So, that is a significant, especially when we think about getting to fully funded, that is a significant kind of component that works a little bit behind the scenes that helps get us there. So, and they're considering a lot of different factors and trying to determine whether.
And that's done every 5 years.
I believe it's every 5 years is when they do their kind of their big tear down of their actuarial.
So that's taken it. So any increases probably in Social Security or costs or inflation are all figured in at that time, but not on an annual basis.
They adopt a set of assumptions that will last over that period of time. I believe there's somewhat when they do the annual actuarial evaluation. I believe there's maybe a degree of sanity check just to make sure that that's.
And then once those recommendations are given to us, who approves those? Can we approve it, or does the legislature have some role in that?
PIBA approves. PIBA approves the actuarial. So that's right.
They can do it on their own.
That's right. Yes, sir. Okay. Yeah. So all of the underlying actuarial assumptions are approved by PIBA whenever they do their experience study. The actuaries do their experience study.
To add one more piece of the answer to your question is, if you'll remember, the legislature back when it did the reform in 2017, after that, there was a 1% per year increase in the matching portion.
Yeah.
I think this past fiscal year was the second year that it had reached that. It was the full amount that it had. So, and that would start to reverse when the plan gets funded to an 85% funded level.
Yeah, and we can contribution rates can start basically. PIBA can start walking those back once we get above 85% funded. So one of the things that I'm we're looking at is, hopefully that comes sooner rather than later. But how does that impact plan liquidity when 10, 15 years down the road when we get to that point again, or get to that point where those contribution rates can start coming down. So that's one of the things that we're already trying to look into the crystal ball to figure out how that could potentially impact the portfolio.
Thank you.
Any further questions on this slide? Okay. From the traditional look at performance here, as a reminder, we have our reference portfolio, which is set to have roughly the equivalent risk as the policy benchmark, which is the target portfolio adopted by the Commission. The implementation benchmark relates to top-down structural differences in terms of how Brian and I are choosing to structure the portfolio. And then the actual plan return is all of that plus how did our managers do. So we are allowed to look through each successive decision on this page. And you can see here that over the last year, the reference portfolio is the best performer. Should not be surprising. That portfolio consists of 70% stocks and 30% investment grade bonds. When stocks are up 18+%, that is almost always going to be the portfolio that wins that race. But you can see that over a slightly longer periods of time, over the last 3 years, our policy benchmark has added value over the simple portfolio, meaning there's been some value just from employing a diversified approach. Aside from that, you can see that we've been very fortunate to add value in other ways that you can see in the yellow boxes, but I want to step aside and pass the baton. Oh, sorry, I need to do one more thing. By policy, we do need to acknowledge that due to some strength in our private equity portfolio last quarter, we were under the 13% limit, but we have moved back over the 13% limit very slightly. Therefore, there is a compliance notification that does need to be made at this meeting, and I want to make sure that I'm being clear about that. So if there are no other questions, I'll pass the baton to Mark. Let me get you to your...
For Jeff, I have one question for you. Yesterday, the Wall Street Journal had an article that said there are a number of pension funds now who are putting pressure on hedge funds to limit their returns, have to be in excess of cash.
Yes.
How do we stand with our funds?
We signed that letter as an organization. We do not believe that a hedge fund manager should view generating the same return that we can get on cash. They should not be viewing that as excess return. So that's why we signed that letter to it's sort of a letter signed by asset owners such as us that is broadcasting our expectations to hedge funds. So,
but are there any actual requirements that cause that now, that returns have to be in excess of cash? Are there any rigid rules for that in our contracts with them?
I mean, we can't control the returns, but we try to structure how we compensate them around that. I can't say that we have, that perfectly in all of our documents by any stretch, but that is the pressure that we're applying.
So that letter that you signed was simply an expression of
our expectations for firms that want to work with us.
And Veris and several other consulting firms also signed that letter, and we are in full agreement with that. So we're hoping that, as Jeff said, not every hedge fund applies a cash rate or some other rate as a hurdle rate for their fee structures, but I think the more pressure we can bring to bear, the higher percentage of them that will be doing that going forward.
Well, and that wasn't, when cash rates are so low, that wasn't really as much of an issue.
Right.
Cash is zero.
Yeah, cash is zero. It's not really that much of an issue. When it's 5 and some change, that becomes a much higher expectation.
Thank you for the question, Ed. All right.
Good. Mike and Jeff asked me to do a little bit of a deep dive on your performance, given that it's fiscal year end, and provide some context and perspective. And one thing I thought maybe before I dive in, as I was thinking about this and I was looking at the universe of your peers, they really fall into 3 broad categories. You're in by far and away what I would consider the largest group. And when I talk about your peers, I'm talking about the top 50 largest pension funds. And the 3 groups, the one that RSIC is in, I'd call, for lack of a better term, that have adopted an endowment model, meaning that you're using a lot of private equity investments, other private market investments, hedge funds in the portfolio, and you have a broadly diversified total return oriented asset allocation. There's another group which is smaller, much smaller, which I would, invest primarily or almost exclusively in the public markets. And you can think of those would invest in something like your reference portfolio or a 60-40, global equity fixed income portfolio. Those are very few. I know Mike works with one of them, but there's a few others in that category. And then finally, the third type is what I would call the de-risking group. And that category are firms that have dramatically reduced their equity exposure and broaden their diversification into real assets, things like commodities and other types of real asset investments, long duration fixed income, and a lot of times those funds are using leverage to try to magnify those returns. And again, that's a smaller subset of the group, but it'll be relevant as we go through and talk about how some of these funds have performed over the years. So with that, and the other thing I wanted to touch on, and Jeff didn't cover this in his, but he usually does with you guys. Whoops, I'm trying to go backward.
Yeah, bottom button.
Bottom button. There we go. Sorry.
Mark, can I ask a question?
Yeah,
before you move on?
Yeah, please do.
That last group you mentioned, you used the term de-risking, but then using leverage.
Good.
Because I was about to ask you, before I heard leverage, I was about to ask you, well, are they de-risking because they've got an improving funded ratio, or they're satisfied with where they are, so they don't want to lose? But the leverage blew it.
But that's a great question. But don't think of leverage. I mean, leverage is a tool. It can be dangerous if not used appropriately. But what they're using leverage to do is and by de-risking, they're primarily taking their equity exposure down and diversifying and basically at the extreme level, they're taking the same level of overall risk in equities as they are in fixed income and in real assets. They're trying to equalize the risk across their portfolio. And then in order you do that, and obviously your return expectation on an unlevered portfolio is quite low relative to what a return expectation on a portfolio like yours would be. So they use leverage to boost that return. Not all of them do. Some of them have just de-risked and do not use leverage, but others will use leverage anywhere. Probably anywhere in the 10 to 20% range overall. And then when you look at their portfolios, even though they have that leverage, they've demonstrated much lower risk than the endowment model or the public markets only model.
Well, there also may be underlying plan components that are requiring them to do so, like if they have significant net negative cash flows or those types of things.
Well, that as part of that, they wanted the portfolio to be de-risked. They didn't want to give up a lot in an equity market drawdown. So that was legislatively mandated. The other ones, the ones that I'm aware of at least, are not well funded, but that certainly could be a strategy if you got to 100% funded, where you could take some risk off the table in that way.
Okay.
The other thing, when Jeff goes through his formal attribution of performance every quarter with you, he breaks it out relative to policy portfolio. He breaks it out by allocation differences, implementation differences from the benchmarks, and then manager performance. And again, I would put RSIC in the broadest category, where most other of your peer funds do the same thing, where they're not looking to add a lot of value through tactical asset allocation moves. That attribution from allocation differences is generally pretty small when you look at it overall across most of your public fund peers. Most, as with RSIC, are trying to add value through implementation by creating a more diverse portfolio within each asset class, and then manager performance at the end of the day. And that's what you've accomplished, not just in the past fiscal year, but over a longer period of time, as Jeff has covered in the past. So here, I just wanted to cover a couple things, and again, Jeff already did, but I would note that, you've outperformed the policy benchmark, not only in the current fiscal year to date, but for every period here going back 10 years. And your longer term numbers, your 5-year number is well ahead of your 7% actuarial assumed rate of return. And the 10-year number is creeping up to that level, just slightly shy of it. The other thing that we look at, and think is a sign of a successful investment program is consistency of returns over time. This is a relatively short window, but it's a 3-year period where we're looking at your quarterly return relative to your policy benchmark. And what you can see there, you outperform that policy benchmark in all but 2 of the quarters since we've been tracking over the past 3 years. So that's showing that not only are you generating excess returns, but it's not coming from one, hit it out of the park quarter, and then everything else is under the benchmark. This is you're generating alpha at a very consistent level overall.
Can I go back just 1 second? Interestingly, those were the 2 quarters where we were early in adding our fixed income exposure back.
Yep.
So we were trying to take down risk in those 2 quarters. It led to some underperformance. So.
No good deed. That's right. Whoops, keep mixing them up. But here's something, on the left-hand side, and again, I'm just going to walk you at a very high level through this, and this is in your quarterly package every quarter too, so just to familiarize you with some of the exhibits that are there. But in the upper left-hand side of this page, you can see the rolling 5-year standard deviation. So we're looking at the risk of the portfolio overall. That's trended up, but really over the last 3 years, it's been pretty constant and pretty close to your policy benchmark. The policy benchmark's the light green line. Your actual risk is the dark blue line. And again, the overall volatility in your portfolio is very similar to that of the policy portfolio.
Mark, this will prove that we don't rehearse this. Where would the 70-30 portfolio be relative to those 2 lines in the top left?
The 70-30 would be slightly lower from my experience, but not dramatically so. We could, that might be a good idea to incorporate it on there.
I would have thought the COVID moment, it would have spiked higher and then maybe settled in.
In a rolling 5, I don't know.
Yeah, fair point.
And but if you look at the rolling Sharpe ratio. Now, the Sharpe ratio is a measure of risk-adjusted return. So what the Sharpe ratio does, it takes your total return, it subtracts out the risk-free rate or the return on cash, and then you divide that by the standard deviation of the portfolio. It's essentially how much excess return are you generating per unit of risk. And there you can see that for a while there, leading up into the 2022 period, your Sharpe ratio is slightly lower than that of your policy index, but really over the past 3 years, and this is a rolling 5, by the way, rolling 5-year Sharpe ratio, it's been consistently ahead of the policy index. And that's certainly something that you want to see, generating strong risk-adjusted returns relative to policy. These bottom 2, I'm not going to touch on in much detail, but on the left-hand side, that's your tracking error. That measures the amount of active risk relative to your policy benchmark. Essentially, it's measuring how different are you from your policy benchmark. So the types of things that Jeff and his team are doing within each asset class, implementation and also manager selection, that will drive the degree of tracking error in the portfolio. And you can see that it's fairly high relative to historical time periods. That's nothing to be concerned about. It's just saying that you have a lot of active risk in the portfolio. At the current point in time, that's not necessarily a bad thing. I mean, we'll talk more about this, but the markets are becoming increasingly concentrated, the equity markets. If you look at and those 60-40 and 70-30 public markets portfolios, the top 10 stocks in the S&P 500 now make up over 37% of the total market cap of that stock of those stocks. And so I think not looking like benchmark indexes is not a bad thing in the current market environment. Here on this next slide, we take a look at the risk return scatter, and let's just focus on the 3-year. You can see that your portfolio on the 3-year is well ahead of median, and I'll talk a little bit more about your returns relative to the peer group in a second. But you can see on a risk return scatter, the return is the vertical axis, bottom to top. You rank very, very high relative to those peers. And then the risk, the standard deviation, is measured along the horizontal axis. Low being at the left side, high on the right side. So slightly above median from a risk perspective, but not very high at all. And then on the far right-hand side, you can see from a 5-year perspective, similar positioning above median returns, but also slightly above median risk. The one thing that I would note, and especially on the 5-year plot, usually you see a trend. Like you would expect higher risk portfolios to generate higher returns over time, lower risk portfolios to generate lower returns over time. And you can see over this 5-year period, there hasn't been a strong trend either way. So I think that's a function of the portfolio would be in the top 1%. I think what's the number? 13.5% for the 70-30 portfolio. That would be off the charts essentially for that 1-year period. And that's again because we've had, as Jeff said, the public markets have rallied, private markets have trailed. But if you look at it over the entire window and you incorporate, if you recall how bad 2022 was, you look at that 3-year window, that reference portfolio would rank in the bottom 5% of that peer group. So I think it just illustrates the benefits of diversification, the benefits of having taking on some illiquidity risk in the portfolio overall. From a Sharpe ratio perspective here, we look at your Sharpe ratio as, again, remembering that's a risk-adjusted measure of return. Your Sharpe ratio over 3 years, again, puts you in the top third relative to peers. So you're getting paid more than most of your peers for every unit of volatility or risk that you have embedded in your portfolio. Over 5 years, right about median, and 10 years, just slightly below median. But the shorter term and the trend has definitely been in the very positive direction there. I'm not going to here just to show you, we have all of this detail in the book. I'm not going to go through that line by line. But I thought I'd be more than happy to open it up to any questions or discussion you wanted to have.
I'd like you to read this page.
I'll leave it on that.
That's a page. Mark, on the I guess all of them. I'm on the record not a huge fan of peer comparisons.
Yep.
Even when they make us look good, I don't think it's I don't get a lot of value out of it. But how much is the nuance in this related to how much in private assets somebody has versus How much does that kind of distort?
I think over the past 3 years, almost nothing. I mean, again, I mentioned the three broad categories. Certainly those the funds that don't invest in privates probably have significantly higher returns for this current fiscal year, significantly lower returns for the 3-year fiscal year, and those that have diversified and have lowered their equity risk exposure that I mentioned. Those are both smaller groups. This is a guesstimate, but I think a pretty good guesstimate. I would say 80% of your peers fall into the category that I would put RSIC in, which is investing, fairly heavily in private markets. 30% seems to be kind of a typical max range for these types of funds. So to answer your question directly, though, Jeff, I would say that for the 3-year and in period, 80% of the universe is pretty much invested, very comparably to RSIC.
Fair enough.
All right. Any other questions? All right. Should we move on to the next agenda item, Mike?
Yeah, that sounds good.
Okay. So as you know, we have an asset liability study coming up. It's something that RSIC does every 5 years per your statement of investment and operational policy. That's SIOP.
Statement. Yes.
Good. So every 5 years we're doing this, and so we're trying to stage things so that we address different facets of it along the way before we throw the whole analysis at you. And so what we thought we'd do here is do kind of a brief education on what does an asset liability study entail? What types of information are we looking at? What type of output should you expect to see? And how do you, at the end of the day, what kind of drives decision making for folks in your seat? And so here, as I mentioned, we're going to stage through this. I think we're going to review the initial asset liability study results in the December meeting. Today, as I mentioned, we're going to do some education. I know Jeff in executive session has a piece that he's going to talk through, giving his views on asset allocation as well. And then you can see in March and April of 2025 is when we're really going to, approve the final asset allocation policy going forward. And again, not to steal any future thunder, but I mean, when I look at your current asset allocation policy and just understanding the nature of your liabilities and your funded status, I don't think any kind of major revision to the asset allocation policy is going to be recommended. We're going to look at some different alternatives, but I think at the end of the day, I think the current policy is pretty effective. So just some quick background, and I'm not going to go through this page by page, but I'm happy to. Please stop me along the way if there are any questions. But the your investment policy statement, or I should say, statement of investment objectives and policies, kind of outlines your responsibility when it comes to asset allocation and the asset liability studies. So number one, this really is the most significant action and most significant decision that you as a group will make in this room. Setting the long-term strategic asset allocation is going to drive 90% of your results, whether it's from a return perspective or a risk perspective going forward, maybe even more than that. As spelled out in that document, it prescribes an asset liability study to be conducted every 5 years. And I think, based on every conversation that we've had with you and with Mike and Jeff and team, I think there's a commitment to say, let's look at this as a long-term strategic asset allocation and not, intentionally not try to tweak it every year as market conditions change, because we think that's kind of a losing game at the end of the day. And then obviously your primary objective is to generate a return that will meet or exceed your actuarial objective, which right now is 7%. Current market conditions will impact that 7% number over time, but I mean, that's the general target. And then to do so, taking a prudent level of risk. And that's something that we're going to spend a lot of time on through the asset liability studies, talking through, all the different facets of risk. We talk about volatility. We talked about it a lot when we review the performance report. That's one element of risk. Liquidity risk is another element. Active risk. You have political risk. All different types of risks that you need to consider as you consider asset allocation.
Again, now that's in the context of the fact that our investment structure is such that we select our managers. So that the whole asset allocation thing comes down to essentially which managers we choose.
Right. Well, I mean, I would say maybe looking at it differently. I think as a commission, you're going to be allocating broadly across the asset classes, public equities, private equity, fixed income, et cetera. Those are the decisions that you make. And then Jeff and his team implement those decisions. And they do so either by allocating to passive mandates, as they do with a lot of the equity asset classes, or to other active mandates within each of those asset classes. So I would, again, say that like 90% of the return and the risk in your portfolio, if not more, is going to be driven by the overall asset allocation that the commission selects. And then, again, Mike, Jeff, and team are identifying managers and strategies to try to add incremental value over the broad asset allocation that you select. So I think the bulk of everything that you do is going to be driven by that. Think of it as your policy portfolio return. And then everything else would be the implementation and active manager returns. So again, as we go through, some of the things that you're required to consider as you make the asset allocation decision, general economic conditions, obviously. We're all in tune with what's going on in the economy, but it's really hard, as I mentioned. Very few of your peers, and certainly even fewer do it successfully, make tactical asset allocation decisions. We think that's one of the hardest things to do, hardest things to get right. But you do need to consider general economic conditions. If you think about it, our capital market assumptions factor in the current conditions, and that goes into our forward-looking return assumptions that I'll talk more about in just a minute. The possible effect of inflation or deflation on the portfolio, that's something that we'll be modeling as part of this as well. The role that each investment or strategy plays in the overall portfolio, and I know having sat through a lot of the deep dives on asset classes, that they do a real nice job of kind of defining the role of each asset class or strategy within the portfolio. Some asset classes have an inflation hedging component to them. Like real assets certainly would play that role. Some assets have a deflation hedge component, fixed income and cash, et cetera. So that's something that's important to note, and we'll be talking more about that as we go through the study. The needs for liquidity, that's something. Again, it's a risk that all pension funds have to face. I think the fact that, Jeff just talked about the fact that you have net positive benefit payments right now, meaning you have net positive cash flow, really is a big advantage to RSIC versus a lot of your peers. I would say the average, and again, this is based on the clients that I work with, but I would say the average would be something in the negative 2.5% net benefit payment range. And even that's pretty good. I mean, that gives you a lot of ability to take on illiquidity risk, but you might be able to take on even more illiquidity risk as a result. And then the adequacy of funding based on reasonable actuarial factors. I'll skip that page. Let me just talk a little bit about how the study works. The key inputs to the study, I mentioned Veris every year puts out capital market assumptions. These are assumptions for return, risk, and correlation across all of the major asset classes. We have a suite of 10-year forward-looking assumptions, and we also have 30-year forward-looking assumptions. And so that's one of the key asset inputs into the model. But we also then incorporate your plan liabilities. And I'm going to talk more about this in a few slides, but that's the benefit payment stream. And how does that impact things? And how do we make sure that we're able to pay all the benefits when due, which is really your primary responsibility as a commission. Current funded status will be an input into the process, and then expected contributions as well. We then, we have a number of different analytical or modeling tools that we use, and you'll see outputs from each of these as we go through this today, just to give you a sample. But then we're going to look at what we consider the decision factors. And again, there's no right or wrong answer. There's a lot of, there are, different levels of risk tolerance. There are different levels of return expectation, different comfort levels with each. So we're going to look at a number of factors: distribution, the potential funded status going forward, contribution expectations going forward. We're going to run stress tests based on different market scenarios. What if we are entering a stagflationary environment? What impact could that have on the portfolio? Looking at liquidity coverage ratio, and again, I think that's something that relative to your peers, you're going to be in much better position right now, given your net positive cash flow. So I'm going to go through each of the key inputs and here at a very high level. And we're, when we do the asset liability study, we'll be doing a deeper dive. But again, as I mentioned, the capital market assumptions, number one, what are the appropriate asset classes for RSIC? I think you have a really well diversified portfolio right now. We aren't recommending any new asset classes to be considered. What is the expected return for each asset class? What is the expected risk? And then importantly, how are they correlated over time? So I think most of you understand the concept of correlation, but correlation really, ideally correlation, measures the degree to which asset classes move either together or separately. So the ideal situation is if you had two asset classes that each had a return expectation of 7, and when one was in positive territory, the other was generating negative returns, and vice versa. And you put those two together, and that would smooth out returns. And that's what correlations can range from +1, which means that asset classes are moving in lockstep with each other in each direction, or -1, which means they're moving in the exact opposite direction. In reality, most asset classes reside somewhere between -0.5 and +0.5. And so that will play a role in how they diversify the portfolio going forward. And again, I think Mike covered this at a prior meeting, Mike Patalski did, on asset allocation, but this just gives you an idea of the return and risk expectations for our current, which we have currently in our capital market assumptions. And not surprisingly, and as I mentioned before, usually you expect to see higher returns associated with the higher risk assets. The other thing I wanted to emphasize, and we've talked about this before as well, if you look at private equity, private credit, now we know there's some smoothing that goes on because you value those at a lag and they're not publicly traded, so they don't necessarily move with the markets always. What we embed in our risk assumptions for those asset classes and all private asset classes, we try to incorporate the true economic risk that's embedded in those asset classes, so that when we model portfolios, we're capturing what we think is kind of a public market equivalent risk for those asset classes. This is a page I wanted to spend a little time on, and stop me if I'm going into the weeds too much, but I think understanding what constitutes your actuarial liabilities is fairly important, especially as we're diving into the asset liability study. And so you think of, we say liabilities, but what it really is that benefit payment stream, and the benefit payment stream that I show on the right hand side of the page is not yours. It's just illustrative, but yours would be kind of similar in shape to that. And what that reflects is the benefit payments that are expected to be made from the retirement system from now until the last current pensioner or beneficiary gets paid their last amount. And so you can see how that trends. This doesn't incorporate expected new participants coming into the plan. It's the existing participants only. And the shape of that curve is really driven by the benefit formula, as well as actuarial assumptions such as salary increases, mortality expectations, retirement, disability, and terminations. So you have this projected benefit payment stream that you can see on the upper right-hand side of the page. What you do, if you discount each of those cash flows back using your 7% actuarial assumed rate of return to present value, that will give you your total liabilities for the plan.
What accounts for the dramatic drop?
Well, again, so we're modeling these are current benefit participants right now. So
this is not your data.
Yeah, this is what's not your data, but it's current. So what happens is as your current population hits retirement age, there's fewer and fewer benefits to be paid after they pass.
The person who's hired tomorrow and joins the system is not included.
Yeah.
Otherwise, it would look like a slope up.
It would be an upward sloping line. And we'll have that in the asset liability study. It'll show the difference between the two. But you can see there that is the current liability. But yeah, by discounting those at the 7% discount rate. And the one thing I wanted to show, so you don't change that actuarial assumed rate of return often. I don't know if you've done it recently.
It's reviewed once every 4 years.
It's reviewed once every 4 years. So the current asset, and what I wanted to show you how that impacts liability. So I wanted to simplify it. So if you look in the middle, that highlighted box at the bottom right, the current discount rate is 7%. If we just take one of those payments, the 2044 benefit payment, which happens to be 11.1 billion in this illustration, and you discount that back, to present day, 20 years, that comes up with at 7%. That gives you a present value of $2.9 billion for that future benefit payment. But if you had a lower actuarial assumed rate of return, let's say you adjusted that to 6, all of a sudden that actuarial liability goes from 2.9 billion to 3.5 billion. Mm-hmm. Likewise, if you had a higher discount rate or actuarial assumed rate of return at 8%, that goes from 2.9 to 2.4 billion. So essentially what we've done, when you come up with your total liabilities, it's effectively discounting every one of those benefit payments back to present value using the 7% discount rate. And that's, again, going to be a key. We look at asset allocation a lot. It's easy to look at in standalone space, but to really incorporate these liabilities and have the same impacts, like inflation is going to affect asset returns. It's also going to affect the liabilities. Other interest rates are going to affect asset returns. They may also affect liabilities. So we're going to model those together. Any questions on that before I move on? So here's your current funded status, or I should say as of June 30th, 2023. The 2024 numbers are not finalized yet, but what you can see there, the actuarial liability, again, your discounted value, when you total it across the 5 plans, equals about $69.5 billion. Assets, you have 2 values of assets, the market value of assets, which is 41 billion, and then the actuarial value of assets, which is just shy of 41 billion. Sometimes those will diverge. The difference between the market value of assets and the actuarial value assets, actuarial value gets smoothed over time. So there's a smoothing element so that if the market value is more volatile, there'll be some dispersion between the market value and actuarial value. But right now they're pretty close. And then you can see your unfunded accrued liability at the total fund level is $28.5 billion, both on a market value and actuarial value basis, for a funded status of 59%. Just for perspective, that's that would put you probably in the bottom quartile relative to the 50 largest peer group from a funded status perspective. But again, recognizing that South Carolina has a plan in place to accelerate funding and to get that funded status up in fairly short order.
Mark, can you go back for just a second? I think it probably is worth tying a concept in here.
Yep.
So our cash flows having turned positive last year, and we earned 10%. Let's make the math simple. So we earned $4 billion. The asset value rises by the full 4 billion, which is how we catch up. So we're not starting at 4 billion and then we had to pay out $1.5 billion. All of the gains last year go to increasing the asset value and therefore are helping us catch up to the value of the liabilities. So, sorry.
No, that's a good point. One more point too. This year, because of kind of the outsized return, but if you think about the overall 5-year return, we're probably more likely to see more separation between the market value and the actuarial value because the actuarial value uses smooth returns versus the market value, which is just, that's the value of assets as of the date. So it'll take a while for the actual we quite frankly may see that funded status number go down. Just because of the, if you look over the 5-year period, like from a return perspective, an annualized return perspective, it's I think it was like 5.34. So, but from a market value perspective, it looks better than it does now. Right. So. And we'll be showing, we use actuarial value to factor in the contributions in our study. We'll also show the market value because we think that's better representation of the true economic status of the plan. So again, and I think we touched on this, the expected contributions, I think one big advantage you have, in addition to them being positive, is the fact that, the 2017 pension reform bill really resulted in more reliable and consistent contributions to the plan. So what that allows you to do potentially is take on more risk. It doesn't mean you have to, but if you wanted to take on more illiquidity risk, you're in much better position now than you were 10 years ago to do that.
What is the likelihood of generals? I know we can't predict what they'll do, but is there, I think there's some pressure there to reduce those contributions when we're more fully funded, or is that the case or not the case? I mean, I guess all I'm saying is as we look out down the road, however many years, is that a factor that we have to weigh or consider?
It will be, yes, because whenever those contribution rates start to come down, then that negative cash flow number will go up. We're still, even though, all things, if the contribution rates stay the way that they are, which is they're in statute, so it would take, you have to pass some sort of legislation in order to deviate from that path.
It's reasonable just to continue in all of our assumptions to assume that the contribution rates will remain as they currently are.
I believe so, yes. And I looked at this recently with James, and if the returns are consistent, which we know they won't be, they'll be good some years, bad some years. But if they were consistent, we don't get there for over a decade.
Okay.
So it is not imminent. But also that there's
in the foreseeable future, we need to just keep planning as we're planning.
Well, and the kind of operationally, the way that it works is once we get to that threshold, HEBA makes the decision as to when to start breaking those contribution rates down. So we don't necessarily have to, the day we hit or the year that we hit 85%, those contribution rates don't have to start coming down. You would probably want to ease into that contribution rate decrease.
One would hope.
Most definitely. That will be an important ingredient in how that needs to work in order to work well.
There are under a lot of pressure from local governments in particular about the difficulty of funding benefits.
That's right. Absolutely.
So, that's the, to a certain extent that, is an impetus for us to ensure that we're able to maintain a consistent, basically to do our part.
Right.
So that to help relieve that overall pressure. Right. Yeah. But prudently.
Well, great. So that was, we were covering there all the key inputs and how they kind of work together, and we'll be modeling these in concert with one another. And then these last few pages I just wanted to cover, and I'm not going to go into a lot of detail because they're just samples, but I just wanted to explain some of the different modeling that we're going to do. And so this first group here on slide 11 is the stochastic forecasting. And what we mean by stochastic is we're doing 5,000 simulations, though, based on the risk and return of the portfolio, based on the elements that impact the liabilities. We're kind of pre-experiencing 5,000 different portfolios, and there's a range of outcomes. And so what these graphs show are the range of those outcomes. On the left-hand side, we're looking at future funded ratio. This is, in this case, this was, could be any time period. We generally look out 10 years to look at the distribution of funded ratio. And the blue box in the middle, that represents the top of the box is the top quartile, or one in four best case scenario. The bottom of the box represents the 1 in 4 worst case scenarios, and the white line in the middle represents the median scenario. And then the whiskers, the lines out, go from the top 5th percentile, or the best 1 in 20 scenario at the top, to the bottom 5th percentile, or 1 in 20 scenario at the bottom. And that's how you would read those. But again, we're looking at 5,000 different simulations of your assets and liabilities to give you a range of potential outcomes. And then on the right-hand side, we do this with employer contributions as well. So you can see that, and those will be some factors that we look at and consider when we make our asset allocation decision. We'll be looking at those for, how do different asset allocation models impact those two factors.
So will we have to, for the expected employer contributions, will we need to make an assumption about when they will rates will start coming down and how much?
Yeah, if we're going to take whatever your current statute is, as statutory requirements are as given, and then the modeling come from there. We can also model it as if there is no, just the actuarial required contribution. So we have different ways of modeling that.
Our statute doesn't require contributions to decrease once we get to a certain level.
To your point, you have to, you do have to bake in a degree of assumption as to how what the behavior will be once you get to that 85th.
Yeah.
That 85% funded. And I think the way that we look at it is we just assume that they will start coming down as soon as we get to that threshold, and they will kind of come down, kind of correspondingly to the increase in funded status. But that may not actually be the experience.
Right. But it's a conservative.
It's a conservative way to look at it. That's right.
To analyze.
Yeah, that's right. We try to think of it like it's going to come down as soon as it's going to start coming down as soon as they have the ability to start bringing it down. And Peggy has brought this up previously, and I think we both have. As again, we would prefer to see, like, we were magically at 85% in 5 years. We would prefer to see a much more gradual slope to those coming down, so that we would have a degree of safety and cushion built into kind of some safety into that. But
maybe 0.5% or 1/4% a year rather than a full percent,
something like that. And a lot of it'll depend on where we are when we get there, to a certain extent. But
does PIPA need the General Assembly's authority at that point to lower it?
There's some parameters on which one they have to bring down first and when they can start bringing down the other. But no, it allows them to do it. And it also, compensates for the fact that if, we experience some significant market event.
or there could be another dumpster fire going on, and this not be a topic of conversation. We're known pretty well for other stuff that goes on that, if there's not a problem here, there's a problem somewhere else, and that's what gets the attention.
Right. Yeah. So that's we'll start kind of also, in the next few years, as we continue to see progress, we'll start thinking about like scenario game planning on what that's going to look like.
And we're working closely with your actuary on that. So whatever they've built into their assumptions is kind of our base case that we're working with.
Yeah.
And then we could also model different scenarios if you want us to.
Yeah. Okay. Thank you.
So then the other type of analysis, we have deterministic forecasting. Here we say, okay, assume that you earn in the bottom left-hand side, let's say, assume you do earn 7% every year for the next 20 years. How do the assets and liabilities move, and what happens to our funded status over that period of time? And then I like on the right-hand side, this is a heat map, and we have different versions, different flavors of the heat map, but it's effectively says, okay, if we earn, our expected return over the next 10 years, what's our funded status? What if we earn 1% less or 1% more, what does that do to our funded status? And we can, again, model contributions, we can model funded status, we can model other things on a deterministic basis, and we'll have a couple of different things to look at in December. And then I mentioned stress testing. This is another thing that we do where we look at different scenarios. So we can run the different asset allocation policies that we're going to be looking at through different historical scenarios. What would have happened in the subprime mortgage meltdown in 07 to 09? How would the different portfolios have performed during the oil price decline, et cetera? So. And then we also have tail risk hedge. We can stress the portfolio in a number of the different portfolios in a number of different ways. We could say what happens if the U.S. dollar appreciates by 20%, or what happens if global interest rates go up by 200 basis points. So that's something we're going to be working with Mike, Jeff, and team to customize. What scenarios do you think would mean the most to you, or would you be most interested in seeing? One thing that we've had requests for in the current environment is the stagflation environment of the 1970s for obvious reasons. So that's something that we could add to the list of scenario analysis. And then finally, liquidity risk. And we have a liquidity coverage ratio. I think we've looked at it for you in the past, but effectively what it is the numerator of the liquidity coverage ratio. And I should mention it was modeled after the Basel III, the banking regulations and the banking liquidity requirements. But we start out with your starting liquid financial assets plus any distributions coming in from the illiquid assets, plus any employer-employee contributions, all the positive cash flows into the fund, plus the return on liquid assets. And that's the part of that numerator that we stress. So we model that stochastically, but, and I'll show you that on the next page, but it shows you, what happens if we do hit another meltdown, 2007 to 2009, and our liquid assets get cut in half. How much liquidity do we have in the portfolio? And then the denominator would represent all of the outflows, benefit payments, expenses, and any capital calls for illiquid assets.
This is, I think, one of the most important things to consider. So I'm glad that this is featured in the work.
And interestingly, so again, just like everything else, and sorry if I sound like a consultant, but there's no right or wrong answer. Well, I get the right answer is you want to be above 1. You want to make sure you have enough liquidity. But again, how much illiquidity risk you're willing to take is subjective at the end of the day. But what you're going to find, I think, given what Jeff presented earlier in terms of the positive cash flow, is that you're going to have ample liquidity in the portfolio. And interestingly, this again was an illustration, but it was actually something I did for another client. And note the header on the graph on the right. It says, what if we only get 50% of our expected contributions? This was a state where when the global financial crisis hit, they made less than half of their they took a contribution holiday. It killed them from a liquidity standpoint. So that's their sensitivity point. They're saying, what if we actually did one where we said, what if they don't get any contributions coming in, because it was so uncertain what they were going to get from the state. Another thing that we did for another client is we modeled what happens. Like right now, their assumptions were that their private equity portfolio was mature and it was throwing off more cash than they were making in capital costs. So it was generating positive cash flow. And they said, what if we neutralize that? So there's a number of different ways that we can look at this. And again, I'll be working with Jeff and Mike and the team to decide exactly what different scenarios do we want to potentially look at for liquidity.
Is that a ratio that should be reported to us every quarter, every year, every 5 years?
That's a good question. We do have some clients that
Seems pretty important.
it's a dashboard for some clients.
Yeah.
And we could, that's something that we could put together. Probably a good thing to talk about it with the asset liability study. Maybe that's something that we look at. Adding.
Yeah, every 5 years
Yeah.
seems too,
Oh, yeah.
way too far, at least every year.
Yeah, I don't disagree. And so that, I guess that overall, that's just to give you an idea of some of the things that we're going to be looking at in December. It is a mosaic. There's no silver bullet. There's no one measure of risk that we're going to say, well, that's the one you need to, you base your decision on. You're going to have to kind of take a complete picture and say, how much illiquidity risk can we afford to take? How much downside or drawdown risk can we afford to take in the plan? How much equity risk do we want to be exposed to? How much interest rate risk? So there's all different types of things that we're going to be looking at. But I think it really is, going through the process is really, again, I think it's the most important thing that you do it every 5 years. So we're going to be devoting a lot of time and resources to it.
Can't wait for the liquidity. It's our time to show off a little bit.
Yeah.
Look forward to that.
So you want to report it weekly?
I'm loving your question. Yeah. However often you want. Right. We stress tested yesterday, so I feel pretty good about it.
Any other questions on the asset liability study or the timeline or anything related?
What do you need from us?
We'll be sitting down with you to kind of fine tune exactly what we want to look at. And
I would encourage you to show some ugly scenarios.
Yeah.
Because that's how you learn.
Yep.
The hard decisions you may have to make.
Yeah.
So.
And then the other, I guess, question or something, in terms of, again, I think your current policy is, I think, very, very, well diversified. It's suitable for what you're trying to accomplish. But I guess we've done them for clients where we show a fairly narrow band of change, and we might show 3 alternative policy portfolios and it barely moves the needle, but it provides maybe if we wanted to gradually go in this direction or that direction. We have other clients that say we want to bookend it with, speaking of extreme, but like what if we increased our equity exposure by 20%, or what if we took it down by 20%? And there you'd see some really sharp distinctions. They probably aren't realistic portfolios for you to invest in. So those are we're going to be working with the team to figure out exactly what we're going to show.
Can I ask this philosophical question? When you talk to other plans, because internally we talk about the margin of safety concept, which the system needs us to generate 7. So do you just try to generate 7 and then half your outcomes will be better or worse? Or is there you try to target something north of 7 to give yourself a higher probability of that 7 being the outcome?
And well, that's right. And then you define what's a reasonable likelihood of, if your expected return is 7, that means you're 50%, right? 50% to get there. So generally, I would say, have a margin of safety, but we also don't want to let the tail wag the dog, because I think ultimately you want to make sure that we're taking the appropriate level of risk. And as Mike said, you review the actuarial assumed rate of return every 4 years. There are environments, or maybe environments, where you have to say, hey, we can't justify 7 anymore. We need to ratchet it down to 6 3/4, or the markets are such that we can ratchet it up to 7.5. There's been the last 25 years, if you look across your entire peer group, and I'm sure in your case too, it's come down from, I think, 8.5% was the median back in the early 2000s, and we're now down to 7% as the median. There will be a time when that might trend back up again.
Thank you.
All right, thank you. I think for planning purposes going forward with this meeting, we're going to get the delegated investment report next from Jeff, and then, assuming that it's not going to be a very long report.
It will not.
Probably take a break. And then, when we come back from break, we'll go into executive session. Unless I've got any objections to that.
Sounds good.
Before we do the break, let's do the motion, and then we'll just be in executive session when we get back.
Okay, we'll do the motion before we go into break. But, all right, Mr. Berg.
So since our last meeting, we have closed 5 additional investments. We have provided materials, but as is always the case, if there are any unique questions about any of them, we can either hand them offline, or Brian is always ready to take the harder question. This is kind of the public notification that we have closed 5 investments, and you should have all of the materials related to it. If there aren't questions, then, Mr. Chairman, that concludes the delegated investment report.
Okay, thank you, Mr. Berg. Mr. Hitchcock, there's a motion that's been written in some of my notes for us to proceed into executive session. Would you mind reading that for us, please?
Mr. Chairman. The motion is to proceed into executive session to discuss investment matters pursuant to SC Code Sections 9-16-80 and 9-16-320, including particular matters related to the public equity and portable alpha portfolios and certain portions of the consolidated annual investment plan and the statement of investment objectives and policies. To discuss personnel matters pursuant to SC Code Annotated Section 30-4-70A1 and to receive legal advice from esteemed legal counsel pursuant to SC Code Annotated Sections 30-4-70A2.
May I have a motion?
So moved.
I have a motion. May I have a second?
Second.
I have a motion and a second. Is there any discussion on the matter? All in favor of proceeding into executive session, please indicate by saying aye.
Aye.
Any opposed, same. The ayes have it. We are now in executive session. All right, we went into and then receded from executive session. And we've come out with a motion. I'd like to read it and then get one of you folks to put it forth, and then another to second it. That based on the outcome of the performance review conducted in executive session, the commission authorizes the compensation increase for Mr. Hitchcock as discussed in executive sessions and instructs the Human Resources Department and other necessary parties to take all action necessary to implement the decision as approved by the commission, and directs that the salary increase will be disclosed to the public and in the official minutes after the increase has become communicated to Mr. Hitchcock.
I say move.
I have a motion and a second. Any discussion? Hearing no discussion. All in favor of this motion, please say aye.
Aye.
Are there any opposed? The motion carries, so it is done.
Thank you, Chairman. Thank you, members of the commission. I believe all the matters that we have to come before you today. It will be appropriate for, I believe, people to adjourn.
I'll call for a motion to adjourn.
So moved.
Second.
I have a motion and a second to adjourn. All in favor, say aye, please.
Aye.
Any opposed? The ayes have it. We stand adjourned. Thank you, everybody.